how do you retain the kind of the value investing mindset when thinking about growth? I mean, you and I have talked often, right, that growth lends itself to all these behavioral biases. Because you start projecting, you start getting enamored about the kind of convexity of growth and the extra kick that you can get out of the valuation if growth happens to surprise on the upside. It's very easy to fall prey to all these behavioral biases. So have you thought a little bit, Bruce, about kind of these organizational rules that we can have to protect ourselves against these type of biases that are inherent to growth?
Okay, so let me say the first thing about this growth return. It's linear in the various elements.
Right.
So when you do a sensitivity analysis, it's not doing a complicated series of Excel runs with different values. You have if the cost of capital is 1% higher, your margin of safety is 1% lower. If the organic growth rate is 1% higher, your margin of safety is 1% higher. The earnings, the current earnings return and sort of the reinvestment return, you can calculate based on history. But you know the effect of a value creation factor of 1/2 versus 1. It adds linearly to this return. The advantage of that is that if you're a good value investor, you want to start with a conservative estimate where you're pretty sure that this is going to be what organic growth is going to be. And the most conservative estimate for these things, unless it's a dying franchise, which is brutal, is going to be just GDP growth for the growth. But you start with that conservative estimate, and then you can tell immediately what the impact is going to be of things being better or worse than you thought, because it is linear in the organic growth rate, the cost of capital, and it's linear in the fade rate. So I think that's the other thing that's crucial about this. And again, it really is part of the Graham and Dodd genius. What they do is they develop a very simple, transparent framework for incorporating the information about the world that you collect. So much more, asset value, earnings power value is a much more transparent framework than a DCF framework. So when you do the sensitivity analyses in your head, you can do them that way. You're not giving free rein in the context of a complicated calculation to your hopes and dreams.
Bruce Greenwald highlights the importance of maintaining a disciplined approach to growth investing by focusing on linear relationships and valuation. He suggests starting with conservative estimates of organic growth, using simple frameworks like asset value and earnings power, and conducting sensitivity analyses to understand how deviations from expectations impact returns. This approach helps counteract behavioral biases by avoiding overly complex calculations and ensuring that investments are evaluated with a clear, rational perspective.